Hey y'all, this is Brita Long for the Happier Attorney, and this is Talk Tuesday. This is Brita Long for the Happier Attorney. And on Tuesdays at noon Central, I go live and I talk about a topic and answer any questions that you guys have. And I know it can be shy because it's live, but don't worry about that. So today's question was on the Facebook group, my Facebook group, Attorneys and Flat Fees. And if you are an attorney, you are welcome to join. Only attorneys can join, though. And the question was, I deposit flat fees in the IOLTA. I don't withdraw until the case is done. If the case carries over to the next year, do I claim that flat fee as income? One accountant I spoke to says yes. I believe otherwise. Any opinions? And we got a lot of opinions that we'll go over a few, but I want you to back up from this question. The first thing to examine is the ethics, and then we'll get into the taxes. So, the ethics of your state, if you're thinking about using flat fees or you're using flat fees, you have to know your state's ethics regarding fees, specifically in regard to whether you can say that they are earned upon receipt or not earned upon receipt, earned upon completion of work, okay? Or a segment of work. That is step one. And it's critical because if it is earned upon receipt, then those funds are going to go into your operating because they're yours. They're not your clients. And of course, we all know you can't mix the two. If they are not earned upon receipt or they are earned instead on a time frame or when X is completed, then they go into your IOLTA until that is completed. Are we all clear on that? So, say for instance, in Washington, where you can say earned upon receipt, when you get paid, those funds go into your operating account, period. They don't go into your IOLTA because they're yours, they're not the client's. Versus Texas, where you can't say earned upon receipt, then those funds go in until they are earned, and we'll get to that in a minute, they go into your IOLTA. But then once they are earned, they need to go, the funds that were earned need to go into your operating. Okay. So the next thing that we look at is your fee agreement. When in the states where it's not earned upon receipt, when is it earned? That depends on your fee agreement. That depends on what you have said in your fee agreement and what the client has agreed to. So some attorneys just wait till the end of the matter or case to get paid. You can do that, but that's a long time sometimes to get paid. I recommend doing it in stages and having dates and completions of certain work. So, for instance, if you're doing estate planning, um, part of your fee would be earned upon the design meeting, okay, a third, half, whatever. And then once that is earned, and that could be the first day, that goes into your operating, okay, because it's not the client's anymore, it's yours because you've earned it. And then the other half would be done upon completion of the plan, for instance, okay? Or in a divorce action, half is earned upon completion of this time or completion of this work, okay? And have it be automatic. And then when that is done, you transfer the funds. You don't let them sit there. Now, I'm not talking about, they have to be transferred within, 5 minutes of completion of the work. But the whole point is that those are your clients' funds, these are your funds, and we don't commingle. So I would not leave my funds in my IOLTA for very long. I would be wanting to reconcile that at least every week, 2 at the most, right? So those are your starting points for ethics. Now we get into the taxes. Now, I'm the first person to say, I don't know anything about taxes. I can't spell tax. I am not a tax law attorney. So the answers that are following were the best answers that I saw from this question on the Facebook group. And these are from tax attorneys. Okay. So one said, as many have correctly pointed out, it depends on your tax year. for a cash-based business, which I would recommend, your tax year is typically January 1st to December 1st. A cash-based business needs to include income in that year the cash is earned, regardless of when the services are rendered, which again, that is going to be based on your trust account. So or your fee agreement, sorry. So we're still in line here. Take, for example, a business that performs services in December but gets paid in January. Is that cash for services reported in December or January? The answer is January. Um, Now contrast this with accrual-based tax based who provides income in the year that the income was accrued. Same example above, it would now include December regardless of whether it was paid out because you have the right to the income that was accrued. If you aren't sure, check with your accountant. Okay. So in his answer with the IOLTA is when the cash is earned by you, you take it out of your IOLTA. We're completely in agreement here. Another answer said that they mostly agree with the above answer, but that it is when the fee is earned, not when you send an invoice. Agreed. That it depends on your fee agreement and whether the IRS decides you've earned the fee if you were audited. We're getting into deep water here, but if you earned in phases, whether it sits and you have unrestricted access to it, it's income, which it shouldn't be sitting in your IOLTA. If you've earned it, it's your money and it has no business sitting in your IOLTA. Okay. And another comment was that someone looked into this and there had been some attorneys who were leaving earned funds in trust accounts in order to avoid taxes in a particular year. If the IRS discovers that you are doing that, it will tax them and you'll get penalties. I would also say that's unethical. A, you're going to get in trouble with the IRS if you get caught, and B, to me that is a clear ethics violation because you are commingling funds. Your funds are in the IOLTA account, and not only do you know that, you're purposely keeping them in the IOLTA to have a tax benefit. So I think you're going to get a double whammy on that, and just don't do that. Like, why are you messing around with the trust account? Don't do that. So this is an IRS attorney, says it depends on your accounting method, but most businesses are cash. So to put it very simply, the income is reported in the year of receipt. Okay. And when she says receipt, I am assuming she means receipt and earned. Okay. So I hope that helps you a little bit, but start with the ethics first. Start with whether it's earned upon receipt or not, and go from there. If you have further questions about this, this is all covered in the Happier Attorney book that you can get on Amazon. And you are welcome to join Attorneys and Flat Fees if you are an attorney. I don't see any other questions here. So if you have questions about working with me or more information about flat fees, go to breedalong.com and you can get all of the information or join Attorneys and Flat Fees on Facebook. So hope this was somewhat informative to you as attorneys. Go ahead and like, subscribe so that we can continue to get good information out to fellow attorneys. So thanks so much and take care.